The most common question that I get from the graduate professionals that I work with is, how do the federal income-driven repayment plans work, and how does loan forgiveness work? So this video is really just briefly going to help you understand how the math works within these plans. So just for the sake of explaining, let's imagine that interest does not exist, and let's say that you have a $200,000 student loan amount and it's all federal loans, and you're on a 20-year repayment plan. Within the next 20 years, your payments are only going to be based off of income. So let's say that based off whatever your level of income is, let's say that you only paid off $100,000 of your loans within that 20-year period of time, which leaves a remaining $100,000 of your loan to get forgiven. Now that leftover forgiven amount gets added to the 20th year's income statement and counts as taxable income, therefore you do have to pay income tax on that money. So in this scenario, if we assume a 30% tax rate, you would have to write a check to the IRS for $30,000 in that tax year. Now, if we wanted to calculate, so now that we know that, if we wanted to calculate the total cost of that $200,000 loan, you would add your monthly payments of $100,000 plus your $30,000 tax bill that you had to write to the government, which would mean that you just paid off $200,000 of loan with only $130,000 out of pocket, which is $70,000 less than what you originally borrowed.